欢迎回来 Welcome back.
Welcome back.
Two speakers. One from University College London, Dr. Saleem BAHAJ, who is the associate professor of the university. He will present a paper on currency swaps, international comparison. Another one is Dr. Gong Chen, who is a senior economist as a representative of office of BIS in Hong Kong. So let's start with Saleem. So Saleem, can you start first?
Hear me okay, honey, before I start? Is that okay? Yeah, okay, perfect. All right, fine. So I'm just waiting to confirm that my slides are up. So I'm not seeing them being shared. Okay, that's good. Okay, perfect. Thank you very much. So it's a great pleasure to be here. So thank you to Hongi and the rest of the organisers for the invitation. I've enjoyed what I've seen of the conference so far, although it's obviously an early start for us, maybe sort of the last couple of sessions. This presentation is on central bank liquidity lines and then compare some international practice, including from the Federal Reserve and the People's Bank of China. It's basically an amalgamation of a lot of work that I've done for my co-author, Ricardo REIS at the London School of Economics. So he's also credited on this talk. So I want to just jump in and immediately explain what I mean by a liquidity line between a central bank. So what these between central banks, what these are essentially collateralized loans at term between a lending central bank, which I'm going to refer to as the source central bank, and a borrowing central bank, which I'll call the recipient central bank in this talk. These lines actually can be reciprocal, so both central banks can play either role, okay? And we actually see that in practice quite a lot. And these loans are collateralized in the sense that there can be a deposit of recipient currency that backs the loan, in which case actually it's structured sort of superficially as an FX swap. So we call it a swap line. That's where the term swap line comes from. Although in reality, it's very different from an FX swap that you would see in the markets, for instance. Or it can be backed by some securities that the recipient bank can pledge in FX reserves, in which case it will be called a repo line instead. And we see that with, say, the Federal Reserve's FEMA facility or the ECB's UEP facility. They are repo lines, not swap lines, although functionally they end up being very similar things. And in modern usage, these liquidity lines are used by the recipient central bank to essentially lend in the source country's currency to banks in their jurisdiction, okay? And that basically allows them to provide foreign currency liquidity to their domestic banking system. That's the sort of the notion behind this. Historically, these have also been used as a tool to manage exchange rate pegs, although that's sort of fallen out of fashion in more modern usage. We really think about them as a tool for the banking system and financial stability in modern times. So what I want to do today in this talk is give a brief history, so I can run through actually where these came from and who has them, and discuss prevalence. I want to discuss motivations. So why are they being set up? What's the actual underlying reason for them? And in particular, the motivations for the People's Bank of China versus the Federal Reserve. I'll give you a sense of current operational features, so how they actually work in practice, and then also discuss, based on my research, the economic consequences. So what do we know about their effects so far? What's there in the data? So that's my plan for this presentation. So onto the history. So actually, central banks have been lending each other money for a long time. You can go back to the 19th century and find examples of cross-border loans between central banks in gold or even silver from the 19th century. Operationally, though, what we see today really dates back to the 1960s and 70s, so the Bretton Woods era. And I've plotted here on this chart the network of the Federal Reserve swap lines in that era, and the bubble size is basically the size of the facility that's under balance. And these were used primarily to essentially fund FX interventions. So they provide dollars offshore for the recipient central banks to intervene in the exchange rate market. And they also were used to support the dollar in a way as well, because it meant that the Federal Reserve could run a current account, the US could run a current account deficit, supply dollars offshore to fund that deficit and prevent European central banks that had surpluses drawing gold from the Federal Reserve's gold window. So that was the motivation in the 60s and 70s. And these actually were quite heavily used, these facilities, and their sort of peak usage was comparable to, say, the COVID era swap lines as a share of US GDP. Okay. Now, obviously, the Bretton Woods fixed exchange rate regime ended, and by 2000, those swap lines were defunct. There was a small network in North America since around NAFTA, but there was also a new network of swap lines rising in Asia. And these were sort of the result of the Asian financial crisis. And again, the motivation was to set up these swap facilities such that Asian central banks could share their reserves with each other in order to pool resources to fight future balance of payments crisis. So that was the situation in 2000, and this was set up as a network of bilateral swap arrangements. Okay, and then over the next decade, things changed dramatically, and the network grew. And this was sort of in the wake of the global financial crisis, where essentially a lot of large global banks struggled to fund their foreign currency borrowing positions. And the Federal Reserve reacted by establishing liquidity lines with other major central banks, such that those central banks could essentially lend dollars to banks in their jurisdictions. So that was the main motivation. And we see these new lines appearing across the Atlantic. Now, in the epidemic we had last year, this sort of situation repeated itself. And again, US money markets became dysfunctional. Offshore funding costs rose for dollars, and the Fed responded by establishing a whole set of new swap lines. And you can see that on this picture from 2020. What's interesting about this is that you can see the model network is actually vastly more complicated than it was even in 2009. What we actually have today is both a big network centered around the Federal Reserve, smaller regional networks centered around the ECB, which is like a sort of euro-denominated repo and swap lines for countries in Eastern and Central Europe, a network centered around the Bank of Japan, which provides yen-denominated swap lines to countries in Asia, and also a very large network centered around China and the People's Bank of China. And these actually have a slightly different motivation. So actually, if you look at the number of connections, China is the country with the largest number of bilateral swap arrangements. And the motivation behind these appears to be to essentially internationalize the currency and also to help facilitate international trade. It's not about so much countries having large cross-border positions denominated in RMB, but more to make sure liquidity is available for trade to take place, okay? And just to illustrate this sort of difference in motivations, I have a couple of quotes here that will just make this point. I'm not going to read them out, but I'm just going to show that the different sort of language that's been used to describe the swap lines between sort of the governor of the PBOC and then the chairman of the Federal Reserve. You can see these two quotes here. So the PBOC swap lines, motivation, if you read the quote, is about, in the financial crisis, money markets were disrupted. It was hard for banks offshore to obtain the currencies that they needed to actually fund trade. And so if we step in and we provide our currency via a liquidity agreement, we can actually enable trade to take place. That was the motivation. Whereas the US motivation was really about the fact that foreign banks, European banks in particular, had large positions within the US. They owned large numbers of dollar assets. They relied on borrowing from US money markets. And when their funding in dollars was disrupted, that had a knock-on effect on the US financial system. Okay, and it caused foreign banks to reduce their lending in the United States, to sell dollar assets, and there was this knock-on effect on US financial stability. So that's the motivation from the US perspective. So there's a quite, even though functionally these lines have a similarity in how they work, there was a different motivation from policymakers. Okay, so let me just explain now exactly how they do operate. So I want to start with an example of the People's Bank of China lending to the Bank of Korea to fund trade between Korea and China. So this is a swap line transaction. So what would happen is that the Bank of Korea would essentially request RMB via the swap line. So it would say to PBOC, I would like to borrow. The PBOC would essentially deposit money in an offshore bank account for the Bank of Korea. And then in a corresponding transaction, the Bank of Korea would deposit Korean won in an account for the PBOC. And this Korean won would serve essentially as collateral for the PBOC's loan. Although obviously, collateral where it's deposit at the bank lending to is kind of, not necessarily the best collateral in the world, but that's how these swap lines are structured, right? You have a corresponding deposit being put in place by the recipient central bank. Okay, and then what would happen is, this would be essentially intermediated via an offshore clearing bank because there are capital controls. So the offshore clearing bank actually sort of handle the offshore payments to the Bank of Korea, and the Bank of Korea would then conduct an OMO or an economic operation, or have an RMB lending facility, which it does, to provide this RMB as a loan onwards to a commercial bank in Korea, who would then post some collateral, and then that Korean bank could then make an RMB loan to a Korean importer, who could in turn pay for goods from a Chinese exporter. Okay, so that's the way we can imagine these liquidity lines facilitating trade. Okay. And the PBOC is doing this at a penalty rate. It will lend to the Bank of Korea at an interest rate above market rates, typically, or above normal market rates. So it only makes sense to engage in this transaction if there are some difficulties in funding markets. So it's like a backstop. That's the idea behind it. But let's make sure that, from the point of view of a Korean importer, it knows it can get the RMB credit it needs to, if need be, if there's a funding shock, for instance. And that means it's able and willing to both engage in trade denominated in RMB. And because, it's engaging in RMB denominated trade, it knows that, it's actually better off potentially pricing its own products if it's an import-export firm in RMB too, because it wants to align the price of the goods it sells to the marginal cost of its inputs. And that's something that we know from theory of currency pricing in international trade. And as a result, by doing this, the PBOC is actually helping to internationalize the RMB. So that's sort of a net effect of this. You're directly encouraging trade via providing the credit, but also there's a knock-on effect from the importer's behavior if it's also an export firm to price goods in RMB too. I'll show you some evidence of that in a minute. Here's an example of what the Federal Reserve would do. This is the HKMA borrowing from FEMA, which is the Federal Reserve's sort of repo facility for foreign central banks. The structure actually is very, very similar. So the HKMA borrows from FEMA to fund the US dollar liquidity facility for Hong Kong banks. The main difference is that, in this transaction, it's a repo line, it's not a swap line. So the HKMA will pledge its FX reserves as collateral rather than providing a deposit of Hong Kong dollars. And they will sit on account at the Federal Reserve rather than being held on account within the HKMA. Beyond that, we basically see the same sequence of transactions. So the Fed will provide dollars to the HKMA. The HKMA will run an open operation, providing dollars to Hong Kong banks, and they will pledge collateral for that open operation to function. And then in turn, it can use those dollars, the Hong Kong bank, to either pay for withdrawals, provide credit to clients, or purchase dollar securities. Okay, so we can sort of see this as a much broader tool. It's not so much about trade; it's about generally providing dollar liquidity to banks offshore. And what we see here actually is in practice, these lines are actually used. Federal Reserve lines more broadly, not just the Hong Kong ones, are used for all three purposes. So we do see these lines being drawn when there are runs on foreign banks. We see that the dollars are used to provide additional loans to clients, and we actually also see that these loans tend to propagate throughout the whole financial system. So, for instance, Eurozone banks, when they draw on the swap line, tend to actually lend those dollars on to branches outside of Europe. So in that way, the dollars sort of flow throughout the whole global economy from the swap line just between the ECB and the Federal Reserve. And we also know that these dollars are used to purchase US dollars on securities and raise the asset price of those securities as well. So those are things we're all seeing in the data in response to this. Okay, so what does that leave us? How should we think about these things? So in terms of the properties of this transaction, this is essentially liquidity assistance to a foreign bank, okay, using the foreign central bank to do essentially the monitoring of both the collateral that that bank is posting and of the bank itself. Okay, so it's the HKMA that has the relationship with the Hong Kong bank, or the Bank of Korea that has the relationship with the Korean commercial bank, and the Federal Reserve and the PBOC have sort of an arm's length transaction there. They're not having to worry about exactly which commercial bank in Korea is doing the borrowing. They can use the foreign central bank as the intermediary in that transaction, and that kind of is a good thing in the sense that, you know, if you think about what the basic function of central banks is, it's the source central bank, it's the Federal Reserve and the PBOC that's best suited to provide liquidity, but it's the Bank of Korea, it's the HKMA, which is better suited to actually do the monitoring of the commercial banks and to make sure that they're behaving in the appropriate manner, rather than, you know, a central bank located a long way away in a different country. Just in terms of the first bullet point here, you can see immediately actually this is an action on the monetary base of the source central bank. Oh, thank you. Okay, fine. Of the source central bank. It's not a situation where the recipient central bank's monetary base is expanding. Neither central bank bears any exchange rate or interest rate risk, and the recipient central bank bears the private credit risk from the transaction. The source central bank is bearing the sovereign risk. Okay, so the main economic effects of this is to impose a ceiling on offshore borrowing costs. Right. So I said these facilities provide at a penalty interest rate. You would only go to the liquidity line as a commercial bank if the market interest rate is above that penalty rate. And actually, the best way of proxying the market interest rate is sort of the cross-currency basis and to see what's the cost of synthetically borrowing in the source currency. And I'll show you some results from that in a second. We also know from the data, and I'll also run through some effects very, very quickly, that these facilities encourage the use of the currency. I sort of discussed this in the context of the PBOC. They generate capital inflows denominated in source currency, and they also raise the profitability of foreign banks with assets denominated in the source currency. So let me just briefly discuss this sort of ceiling offshore borrowing costs. I think I have a minute or so left. So this is this is for the US. So in November 2011, the Federal Reserve cut the penalty rate it charges on the swap line from 100 basis points to 50 basis points above OIS. So prior to that cut, what I have here is plotting basically the distribution of essentially the cross-currency basis using high-frequency tick data for the month of November. And so prior to the cut, we had a 100 basis point cap, and you can sort of see this sort of almost effective ceiling on this offshore borrowing cost measure. Once the cut came in, this just 50 basis points, and then you look at the distribution in December, the whole distribution of offshore borrowing costs in dollar terms shifted down below the ceiling to 50 basis points. Actually, that wasn't the case also for currencies back swap line, just to show it sort of survives a different diff. And actually, the same results hold for the RMB too. If you do an exercise and look at currencies with and without the swap line with the PBOC, and just look at the cost of synthetically borrowing RMB in the periods before and after those agreements were signed, you do see a decline in the cost of borrowing offshore in RMB around the swap lines being put in place. It's also the case that when these swap lines are signed from the PBOC's perspective, we do see an increase in RMB usage. This is plotting the median and means countries' use of the RMB for international payments before and after a swap line with the PBOC is signed. And you can see this sort of quite dramatic increase in the use of the RMB for both the average and median country when those agreements come into place. There's actually not much effect on trade, however. It's mainly coming through currency usage. So I'm basically out of time. I'm going to skip these last few slides. But these just make the point that there's capital flows that arise from introducing these facilities, and also that as I said, that the returns on bank equity go up when a swap line is introduced for banks that have assets denominated in the currency of the swap line. So let me just conclude. So these liquidity lines are now a pervasive part of the international monetary system. I saw this, you showed you this chart of all these different lines currently in place. They're win-win. So for the source central bank, you can generate capital inflows. It can boost asset prices. You get your currency being used internationally. For the recipient central bank, it's support for the domestic financial system and banking system. There are some open questions. There's a cost in terms of encouraging risk-taking and moral hazard, as there is of any sort of lending facility. There's a question about what the right contract is. So we have these repo lines and swap lines. Are they designed appropriately? I don't think that's really been thought through yet in the academic literature, let alone in policy space. There's also a question about sources of segmentation. So obviously for these lines to make sense, you need to have some segmentation between offshore and onshore money markets. And exactly what causes that segmentation, I think, is up for debate. And perhaps policy could work on fixing the segmentation as opposed to having quite broad liquidity lines instead. So I'll stop there. Thank you very much. I really enjoyed speaking to you all.
Thank you very much, Saleem. Thank you. This is a great presentation. So let's have a couple of questions before you end this presentation. So I can see in your presentation, you mentioned Governor Zhou Xiaochuan mentioned it. The China's swap line basically is promoting the trade. And then the US Federal Reserve swap line from Ben Bernanke basically is helping the financial stability during the financial crisis. The US Federal Reserve help those like say European central bank to to have a swap line to help those domestic banks. So they are for two different reasons. And from your work, your study, you prove that both serve their purpose, both works. So certainly that's a good sign. But now there's an argument. So as you mentioned in your last slide, the swap line is a sort of a part of the international monetary system. And then people argue, well, this big central bank, they provide enough swap line, then you don't have to go to IMF or like a BIS for some emergency funding. You think that was sort of like it's a supplement, or you sort of like it's a substitute to the IMF funding?
Yeah, I mean, I think they're complementary. I mean, they're just the nature of the loans is very different. So I think the historical swap lines, where it started from in the 60s, they were substitutes, right? Because we know that countries, including the UK, went to the IMF to replace funding it lost via its swap lines. In modern usage, these are loans of 1 week or 3 months, and they are collateralized against commercial bank assets. And so that's a very different structure to, say, the IMF, which is coming in to deal with fiscal or balance of payments crises, right? So it has like a different role. Those crises often require loans at much longer maturities. They require fiscal reform or economic reform. Whereas if you think about what the ECB was going through in the global financial crisis or in the COVID period, it wasn't the case that Eurozone fiscal policy was inappropriate. It was the case that you had large banks in the Eurozone with dollar-denominated debt positions that needed funding, and that wasn't really necessarily an issue of Eurozone governments behaving badly. It was more the fact that US money markets were closed, and they relied on those money markets, not closed, but they had severe outflows. I think it's similar for the PBOC too, in the sense that this is aligned to promote international trade. I mean, I know there's been some use of the Chinese swap lines for augmenting international reserves. I don't think that's what they're necessarily for. I think that's probably something that we won't see too much of in the future. But in general, the IMF is not in the business of providing short-term trade credits, right? That's not what the IMF is for, again. So I think they're complementary and they fill a different role.
Thanks, Saleem. Last question is, for the swap line, from the Federal Reserve swap line contract, you can see the Fed was very careful about managing the risk of the swap line. They have this specific account and then specific purpose for how the receiving central bank use that money for those domestic banks. For China's swap line, I think it is rather general. It's just a swap, and then there was a rumor that some central bank, they took the RMB, they just sell it in the market for US dollar. So from your point of view, how to manage the risk if a central bank conducts swap line, say, for example, if you advise PBOC, what would you say to manage that risk?
I mean, so the PBOC has the right of refusal. So it should definitely be asking what the money is for. However, what I would suggest more generally is to emulate what the Federal Reserve does, and actually what some other countries with PBOC swap lines do, say Singapore or Korea, where you ask the recipient central bank to set up a dedicated RMB denominated lending facility and say, if you want to draw from the swap line, I want to see the demand from your commercial banks for the credit, such that you know that the loan is going for a specific purpose, which is to provide funding for commercial banks in need of that funding, particularly for providing trade credit, which is what, say, the Singapore Monetary Authority does. And that means that you know that loan is not being used to, say, buy dollars and pad FX reserves, which is a concern that's arisen from, say, some countries' use of the PBOC swap lines. I think if you have a dedicated facility where you know that commercial banks are money, you'll fix that problem.
Thank you, Saleem. Thank you very much. Let's end this presentation here. So next, we will have Dr. Gong Chen from BIS to present a paper on China's role in development finance and debt relief overseas. Dr. Chen, please.
Thank you. Hello, everyone. Good morning, good afternoon. And this is a pleasure for taking part in this very interesting conference. And so I'm going to talk about, so following actually the previous paper, which talked about bilateral swap lines, I'm going to talk about China's role in international financial architecture, but from a very different perspective. So to focus on China as a lender and also as a debt relief provider. Before I start, of course, the usual disclaimer applies. So the presentation, the views in the presentation are my own and do not reflect those of the Bank for International Settlements. So as I mentioned, China has become a very important creditor in providing development finance. And in many countries, China is the most important bilateral creditor, and in some cases, even the single largest external creditor of any type, so compared with other official lenders or even private lenders. And here, I provide a chart to illustrate China's role as an official creditor in Africa. So data come from China Africa Research Initiative hosted by Johns Hopkins University, and you can download the data using the QR code provided on the slide. So you can see that up to 2019, China provided 153 billion US dollars loans to African countries. And if we look at actually the evolution, the blue bars over time, we can see that there's even acceleration from 2015, 2016 after the launch of the Belt and Road Initiative. And those loans actually primarily have been to three sectors. So transport, and power, and also mining, which represent almost 70% out of those 153 billion loans to African countries. So this big role as an official creditor also makes China a very important player when debtor countries, borrowing countries face debt overhang problems. So to give you an example, so in 2020, 2021, during the pandemic, Chinese lenders have provided at least $12.1 billion relief to many countries within the G20 Debt Service Suspension Initiative, DSSI, but also beyond that. So in my talk today, I'm going to put this, so China's debt relief operations into a historical perspective. So to show that actually, the DSSI is not the first time for China to provide debt relief to developing countries. And on the contrary, as you can see from the map on the right-hand side, so China has provided many debt relief operations throughout the past 2 decades, especially in African countries. So I'm going to talk about a database I worked on with my co-author in the past few years, and you can download actually the papers which talk about this database using the QR code as well. In my presentation, I'm going to mostly highlight 2 aspects about China's debt relief operations overseas. One is about the restructuring terms. So when China have provided debt relief, nominal debt treatment versus debt rescheduling. And another important aspect is about the interactions between China and other types of creditors. So to start with the data, We basically worked, built our work upon aid data several years ago. But aid data actually, which is pretty much actually under the radar these days, mainly provide data about loans. So for instance, Chinese loans to developing countries. In that database, they included a few debt restructuring operations. And from that basis, actually, we conducted an extensive press research using dedicated, actually, search engines like Factiva and also DebtWire, but also Google News. On top of that, we also check, whenever possible, official documents from different ministries, including from China's Ministry of Finance, Ministry of Foreign Affairs, but also ministries from the debtor countries. And on top of that, we also check official program documents from the IMF, which also include quite important information about debt restructuring operations. So after all this, we gathered data about 140 restructuring cases that China has provided between 2000 and 2019 in 64 countries. So this is right before the pandemic. So the DSSI period is not included. The total amount of debts China treated, either in terms of haircut, but also like extension of maturity. So the total amount of debt treated is close to 60 billion US dollars. When you think about this number, of course, we need to be very careful because in the news and also in other research works, you may encounter different numbers. But this really depends on what we mean by official debts and what are the counterparties from China. So in our database, when we talk about Chinese lenders, so that includes the central government, but also policy banks like Exim Bank, and together with other state-owned banks, so commercial banks, and the state-owned enterprises. In a few cases, actually, we have data about China Development Bank, but this is rather an outlier. To give you an overview of our data set, so you can look at the graph on the right-hand side of the screen. So the first graph shows you the evolution of debt restructurings provided by China in the past 2 decades. And we can see that, so both in terms of occurrences, so this is the line, and then also in terms of the size of debt treated represented in bars. In terms of the occurrences, you can see that, so there is a sort of a very cyclical pattern there, and you can see peaks around certain years. This is because African countries received the most debt relief operations took place in Africa. And for African countries, actually, the debt relief was pretty much driven by a big event actually led by China, which is this China-African Forum. So you can see the blue bars, which represent important meetings within this platform launched in 2000. So whenever there is a meeting, especially like a summit meeting that gathered the Chinese top leadership and also African country leadership, you can see that actually the number of restructuring increased. We also see that in terms of the size of debt treated, the size has been increasing over time, especially in the second part of the second decade after the 2000s. So the number is increasing over time. You may also notice, so on the left-hand side panel, the second panel, you can see that so most of countries have received 1 or 2 debt treatment from China. But in some cases, we also see repeated debt treatments that countries have benefited from China. This is the case, for instance, of Sudan or Angola that received debt treatments up to 7 times with China. And to further talk a little bit about this regional heterogeneity, so I show you this table and with some summary statistics across different regions. So you have here Africa, Asia, Latin America, Middle East, and Central Asia, and the Pacific Islands. And here the numbers are means, so averages, and into parentheses are standard deviations. So as I have briefly mentioned, African countries have received most of restructurings took place in African countries. So in total, we count 87 cases out of 140. So almost like 70% of cases are concentrated in African countries. However, one particular fact I want to highlight is African countries have not received large restructurings. So in terms of the size, Africa didn't receive the largest debt treatment compared to Latin America and also Middle East countries. So here, for instance, Cuba and also Iraq have received the nominal debt treatments, which are much higher than any African countries have received in the past. So this, I think, is worth mentioning fact. Then let's talk about restructuring terms, which are also evolving and which in the Chinese case is pretty interesting. So broadly speaking, when we talk about debt restructuring, we talk about two ways to treat official debts. On the one hand, so creditor countries can provide outright cancellation. So we can refer it to like a haircut or nominal debt treatment. So these events are represented by the red and blue bars in the charts I put on the slide. On the other hand, we can talk about the debt rescheduling or debt restructuring in NPV terms, in net present value terms, meaning that the principal value of the debt is not reduced. So if a country owes 100 million debt to China, the principal value remains the same. However, the country would receive a longer period of time to repay instead of within, like, say, 15 years. The maturity can be extended to 20, 30, or even 50 years. So those cases I call what I indicate here on the slide as debt rescheduling are represented by the yellow bars. So one important fact I want to highlight here is out of 140 cases, roughly speaking, we have 100 cases of debt forgiveness, so with nominal debt treatments. Here there are two cases possible. So one is nominal treatment or debt haircut. This is the standard case. We call it the principal haircut. But when debtor countries receive the debt treatment from China, there are also many cases when a country has already, technically speaking, defaulted, already runs arrears vis-a-vis China, and then China canceled all the accumulated arrears. So this is a separate case we want to separate. We want to identify within this broad group of nominal debt treatment. So those are arrears cancellation represented by the blue bars. But altogether, still, China, one message I want to send is that China has provided, in many cases, nominal debt treatment, so with haircut. However, those cases rather occurred before 2010. I will show you a bit why this is the case. In more recent years, we can see that actually the yellow bars have increased quite a lot in terms of occurrences in recent years. And then another comparison we need to make here is in terms of the debt treated, so the size. So we can see that debt forgiveness is still relatively small in size compared to rescheduling. So in rescheduling cases, China is rather generous in terms of to treat quite a large amount of external debts in particular countries. For instance, on the if you look at the right-hand side panel, you see actually a large yellow bar in 2015. That was actually the year when China provided a debt rescheduling of 21.3 billion US dollars external debt to Angola. So a very particular case. Now I move to the second part of my presentation to talk about the interaction between China and other types of creditors. First of all, I'd like to showcase actually the space for sovereign debt restructuring, which is pretty interesting because since even 2000, actually, IMF has been promoting this idea about the sovereign debt restructuring mechanism in order to facilitate an orderly treatment of official debts. So broadly speaking, there are two types of debts that could be restructured in my talk. So one is official bilateral debts, meaning that the creditor is a country. So either the Paris Club or China in the scope of my presentation. On the other hand, so there are private debts. A debtor country, the government of a debtor country has borrowed on the market either from big banking groups in terms of syndicated loans, or by issuing bonds in international financial markets. So there are actually changes for these two types of debts, official debt and private debts, in terms of restructuring. So traditionally, the Paris Club, if we look at the red boxes, so concerning official bilateral debts, the Paris Club has been the major player or platform to treat official bilateral debt. So the group was formed in 1956 with the Argentina debt crisis. So the Paris Club has played a very important role to treat official bilateral debts. But one big change has occurred in recent years, as we have seen already with our data set. So quite a few emerging market economies have become creditors to developing countries. So not only China, but also we can cite India and also Saudi Arabia and other countries in the Middle East. So how to incorporate those EME creditors into the Paris Club framework, or to think about how non-Paris Club official creditors would restructure official debts. This is still a pending question. We don't know much about it, especially in the case of China. And on the second part, so as regards private debt, so there are also important changes because since the 1990s, emerging market economies and the developing countries have used more and more international financial markets to finance their government projects, so by issuing official bonds instead of using syndicated loans. So traditionally, the London Club is used actually through creditor committees to deal with bank loans in cases of sovereign debt workouts. But more and more in this sphere, there are hundreds or thousands of bondholders that need to, that have become important players to provide debt restructuring. But the approach is quite different. So here we can think about new contractual arrangements. So it's important to place China in this space for sovereign debt restructuring. So how China interacts with the Paris Club, and also private lenders. Especially here, there are two arrows I placed on the slides. It's in terms of comparability of treatment, which is important, the working principle for the Paris Club. So the Paris Club always try to encourage debtor countries to approach other types of creditors to provide similar debt treatments in the case of debt restructuring. So first of all, let's look at just from a historical perspective, whether we see how China is placed vis-a-vis the Paris Club creditors and private creditors. So on the charts, you see as before, so on the left-hand side, you see the number of debt treatments provided by three types of creditors. The red bars representing China, the blue bars representing the Paris Club, and the yellow bars representing private creditors. And here is bank loans and bonds, so bondholders and banks all together. On the right-hand side panel, you see the debt treated in terms of the amount. So one thing we notice is the red bars have been there, right? I mean, China's debt relief operations have been an important complement with the Paris Club restructurings in the first half of, in the first decade after the 2000s. As we can see that there, so from 2000 to roughly speaking 2015, you can see that the blue bars are very much there together with red bars. So this is because the Paris Club was still finishing the program with the World Bank and also the IMF, so the so-called HIPC initiative to treat debts in highly indebted poor countries. And there, China has probably provided debt relief together with other official creditors. However, after 2015, you see that the blue bars, in terms of the occurrence, the number of treatments, blue bars have basically disappeared from the scene. So China have more or less substituted to the PES Club as an important debt relief provider for the developing world. However, once again, if you look at the size, it's a slightly different story because the size of debt treatments provided by China remains relatively small compared to other types of creditors like the Paris Club and also vis-a-vis private creditors. And if we dig a bit more into this question about whether there's a de facto coordination among different creditors, so here I look at, so for a given debt relief operation by China, I look at whether there is another type of restructuring provided by the Paris Club or by private creditor around a defined window, for instance, the same year, plus or minus 1 year, so in a 2-year window, or in a 4-year window. The left-hand side panel represents the interaction with the Paris Club, and the right-hand side panel represents the interaction with the private creditors. So one thing I want to highlight is 1/3 of Chinese debt restructurings were accompanied by Paris Club treatments in a 4-year window. So this is the third, small panel, the third panel on the slide. And especially in those cases, you can see that the blue bars are very large in the sense that China, when there is a Paris Club, when Paris Club is also treating official debt in a given country, China is more likely to intervene as well, and also by providing principal haircuts. And the same is, if we do the same exercise with the private creditors, we see that the interactions between China and the private creditor were less evident. And so here I want to emphasize that, so de facto coordination between China and the Paris Club even happened before the DSSI. And China was several times invited to participate in the Paris Club's monthly Tour d'Horizon to talk about debt relief. But here, China is an ad hoc participant and is not a permanent member. So to emphasize a bit more so the dynamics between the Paris Club and China, one thing we can see is the relative weights of the Paris Club and China is likely to be reversed in the future. This is because the Paris Club no longer holds a large exposure or credit exposure to developing countries compared to China. So here in the table, I provided you actually to look at the share of Chinese debt versus Paris Club debt in a given country at the time when China provided restructuring. So you can see that before 2017, so if you look at the restructurings that happened in the first decades after the 2000s, actually China's debt represents a fraction of the Paris Club debt in a given country. And the situation completely reversed if you look at the more recent debt restructurings in African countries, but also in Venezuela, in Latin America. So here, the situation completely reversed with China dominating the Paris Club at the time of restructuring, especially in the case of Zambia. And to continue with one important aspect is why we care about the China's participation. This is because many countries, when they solicit debt restructuring, it is because they have approached the IMF for official financing. They are in a very difficult economic situation. So China, if the financing gap cannot be closed with the IMF financing and the national fiscal adjustment, debt restructuring needs to be provided. And in this case, if we think about the relative size between China and the Paris Club, China needs to play a role and provide debt restructuring. So here I also look at the interaction between China and the IMF programs, and just want to highlight one point, which is the size of debt treated by China is positively correlated with that of the IMF program for non-PRGF cases, so not for the highly indebted poor countries. So this red line, upward sloping line represented on the chart. So to conclude, that vulnerabilities and restructurings may still haunt low-income countries in the coming years after the pandemic. And here we already talked about like debt referrals and rescheduling. They may not probably sufficient to boost the growth. So we need to think about the longer-term framework of debt treatment. And here China has an important role to play. Especially China provided debt relief in terms of debt, nominal debt haircuts in the past, but tended to provide more debt rescheduling. So we need to think about whether this will be happening in the coming years, and if this is the case, how to help debtor countries out of debt overhang traps. And another important fact actually highlighted is the interactions between the Paris Club and China in a de facto fashion before the DSSI and in a more degree fashion during the DSSI period. I think it's important for China to participate in this multilateral framework for debt restructuring. I mean, it's a win-win situation for the Paris Club, I think, because China is a big creditor, can provide a lot of help for the developing world. And on the other hand, this also enhance, for China, it's useful for China to enhance transparency. And for the debtor countries, actually, this is an important way to unlock new financing. Just to come back to this space for sovereign debt restructuring, probably looking into the future, there is a new space emerging. With the Shanghai Club, why not? Because now there's a new paper by 3 authors. They have argued for a new paradigm called the Shanghai Club. You can download the paper using the QR code. So here probably to embed some Chinese characteristics about the debt restructuring to factor in ESG objectives or to think about the debt equity swap and so on and so forth. So maybe there are new ways ahead. Thank you.
Thank you very much, Dr. Chen. Thank you. So you made a very, very insightful, very interesting presentation. If I can summarize some highlights, you mentioned that China actually did like $60 billion debt restructuring. Among them, 22 billion was actually waived. So it's about 37%. And also you present the China's debt restructuring, the interaction between China's debt restructuring and the Paris Club, and then also the IMF financing. Recently there's a big debate. People argue that, China in the past 10 years did a lot of infrastructure lending, say Belt and Road lending to the developing world. Recently, a debate is some people argue, that would be a debt trap for those developing countries. So China was have some kind of a agenda behind it. And then from your presentation, from your data, it can be seen that China actually is very straightforward in a way, give a lot of haircut, just waive the debt. Also, recently, Nancy Chen published an article in Project Syndicate. She argued China's debt finance. Actually, the terms, conditions are much looser than, much generous than the multilateral banks or other countries. So I want to ask you the question is, what do you think of the debate that China actually is too generous? Also, of course, or China actually try to sort of like put those countries into the debt trap.
Thank you very much, Hongyi, for this question. I mean, it's a very broad and very difficult question, but of a very important significance actually in the current academic research and also policy debates. So from my perspective, if I look actually at the data we have worked on in the past few years, I think there are 2 points I want to mention here. One is, I think debt restructuring is a learning process for China, but has also been a learning process for other countries as well, including the Paris Club. Because the Paris Club, this is from my previous research on the Paris Club, they have also been changing their behavior or their practices in terms of debt restructuring, in terms of learning by doing. At the beginning, for instance, very little nominal haircut was provided. Basically, between 1956 and end of the 1980s, the Paris Club provided very little nominal debt relief. And then this part, debt relief actually increased during the 90s and the 2000s, especially with the HIPC initiative. So I think that China is still in a learning process actually to think about how to do, how to provide, because that hasn't been a question actually, say, 10 years ago, because this question becomes more and more relevant in the context of increasing Chinese loans to developing countries. So this is one point I want to mention. So the terms actually are not fixed, they are evolving. I think they are evolving also based on many financial and also non-economic constraints that China is facing. For instance, to think about whether to provide haircuts or to provide maturity extension or in terms of debt rescheduling, there are many factors behind. On the one hand, maybe we can think about like economic growth, maybe to provide outright nominal haircuts. This is the most straightforward way to provide new oxygen for debtor countries in order for them to use limited resources for development. But on the other hand, there might be moral hazard issues. Also, there is a problem with inter-creditor coordination issue. On the other hand, with debt rescheduling, maybe the treatment is more progressive, so we want to see immediate economic effects for debtor countries. But in the long term, maybe this is also a better way actually to keep new financing flowing into the country, because investors, they didn't actually face a lot of haircut, or the economic costs for them are lower, and they are more willing actually to provide new financing. So I think this is a very delicate balancing act to think about. So there is not a straightforward way to say which one is better. I think really depending on country situations, and also whether there are third-party creditors that are also there to provide the financing or to provide the debt restructuring. Maybe I can add another point about this debt trap discussion. I think here one important thing is also to look at the asset side. There are quite a few scholars, like at Boston University, also at Johns Hopkins University. They have also been looking into how much assets China has left to developing countries, because this is also an important aspect to factor in when we talk about debt restructuring. So it's not only about how to treat the legacy debt. It's also about to see whether there are new roads that have been built and up and running in the country. So these kind of long-term economic effects are also not negligible. So we probably in this case we need to look at both sides, so the purely liability side in terms of sovereign debt, but also on the asset side, so whether the asset that has been built contributes to the economic growth and long-term productivity enhancements, and so forth, in debtor countries.
Thank you, Dr. Chen. Another question, the last question actually, is related to the debt restructuring. The Chinese government has doing a great deal of debt restructuring, and also in the past 10 years, the Belt and Road investment has been huge. And then, say for example, in the debt restructuring, in the London club, the market actually provided discipline. So if you actually don't pay back, then you will be shut out of the capital market. But from the government debt restructuring, the Paris Club or China's point of view, if China is a big lender, how to prevent the moral hazard, how to prevent those recipient countries, they have the money or they just, they just don't want to pay. They just keep on borrowing. If you advise the Chinese government, what do you would advise them?
Thank you, Hongyi, for this question. I mean, it's also a very difficult question, challenging question, but I think it's also a very important one in the sense that, as I have mentioned, so debt sustainability and also debt restructuring, I mean, has always been a very delicate balancing act. There are many factors and many aspects actually to look at. So here, I think you pointed to a very important factor, which is what is sovereign debt, right? And so on the both sides, on the recipient side, this is easier to understand. So basically, it is the debtor countries, the government in the debtor country, or it is a public enterprises, but backed by the government to build a road or to explore like mining, so on and so forth. But from the creditor side, it's not that clear. So in the case, actually, we talk about China as a creditor. China is multifaceted, right here. We talk about Chinese governments, but we also talk about the policy banks, commercial banks, state-owned enterprises. They all have different practices. And especially actually the part from the Chinese government has been limited in terms of credit to developing countries. So here, probably one way to think about it is we need to think about the balance between purely government-driven lending. So this can be grant. This is necessary, like a development aid, which is super important for developing countries, which can be administered by government agencies, ministries. But when we think about other types of activities in terms of, for instance, for infrastructure investment, so the Chinese government doesn't necessarily need to be the creditor. They can delegate actually this job to private entities. It can be state-owned enterprises, but it can also be like private money, right? So then you have these markets, this market discipline there. They will look at the profitability. They will seek for safeguards or guarantees. So there are practical, actually, arrangements that can be put in place. Also, we can use like contractual arrangements that I put on my slide, but I haven't detailed in terms of like collective action clauses or pari passu when we talk about when the debtor country wants to use more bonds instead of loans. On the government side, let me end my answer here. Also, I think one progress we need to highlight is that sustainability has been embedded in the policy objective function of the governments when designing external aids and also project financing. So I think this is a very important step forward. Probably ex ante, we need to think about whether the debt situation is sustainable, and then to tailor official lending based on country-specific situations.
Thank you very much. Thank you, Dr. Chen. So let's end this session here. So we'll take a break and we'll come back in half an hour. Thank you.
Thank you. Thank you.